Schatzker, our next guest was one of the first people to find a way to trade bank loans. He was just in his 20s at the time. Now he runs his own hedge fund and consults for the Federal Reserve on systemic risks. And he says there's a decent chance the financial markets will undergo another flash crash-like shock. When is the question. Peter Lupoff is founder and CEO of Tiburon Capital. His firm just celebrated its one-year anniversary, and he was previously at Millennium Partners. Peter is here with us this morning. Peter, you told your investors last month we are one event away from another market move like the one we had in May. What do you see happening?
Well, it's any number of things. I mean, if Nassim Taleb talks about the black swan is an unpredictable event. I would say the market seems to be reacting in a reasonable way to the pigs, to Ireland, to the prospects of what occurs in Europe. What we don't know is, I think in one of my white papers I quoted Don Rumsfeld saying they're the unknown unknowns. And the unknown unknowns can create that kind of market shock. Now, I'm not saying that's a tomorrow event or a next year event, but clearly we have to manage with that in mind, that that's always looming.
Well, you also said that you are making bets on disaster insurance, not for the purpose of hedging, but because you see potential opportunity. Is that to say, in the context of black swan events, that once again people are mispricing tail risk, and it's actually cheap to buy this out-of-the-money option, so to speak?
It appears so. I think that, we're deep value bottoms up by our training. We're event-driven as a strategy. But when we pull the camera back, we work in a world where macro factors matter. Technicals probably outweigh deep value in this time and place. And when we pull the camera back, we see a number of things that can create significant opportunities being short, and where those options are intrinsically cheap, whether it's currency-related, commodities-related, what have you.
Peter, before the break, we were talking about how you saw opportunities to benefit from maybe not a disaster scenario, but a severe retreat in financial markets, move away from risk, let's call it. Where? You said currencies, commodities. Let's get a little more specific.
Well, let's talk a little bit about what's really in the portfolio presently. When we develop ideas, and which is our strong suit, that's our reason for being, sometimes we'll impose a top-down macro point of view. Among them would be, as I mentioned a moment ago, that regulators have heightened authority in these present markets. Now, we run our pool of capital as fiduciaries. It's not a source of a political point of view. So I'm agnostic about those things. It's just very really is the circumstance that regulators have heightened authority. They're seeking companies that have misbehaved in one way or another, taxing them. They have taxing authority. So a macro thesis of ours for the last year or so has been to look at Department of Justice inquiry, whether it's price fixing, tampering with foreign officials, regulatory intervention in industries like the for-profit education space. This is a theme that can play out in a portfolio more or less regardless of what happens in Europe.
Regardless of what happens in Europe, interesting. You, Peter, are among those people who believe that ultra-low interest rates got us into trouble in the first place, effectively creating a bubble and forcing investors to go chasing yield. Are we really in the same situation once again, maybe even augmented by QE2?
What's kind of interesting how much dialogue there is on this topic. We're extremely self-aware of it after watching what happened from 2003 through 2008 with virtually zero risk-free rates. At the same time, there's enormous amount of capital on sidelines looking to be deployed. It is very much the fact that when rates are managed to a zero rate of return, investors will reach for some rate over the risk-free rate. And what we're in right now, and I've written a white paper on the topic as well, is a period that feels like multiple equilibria, where there's
schizophrenia.
A form of schizophrenia in markets, where on one day there's risk on and the next day there's risk off. It's not like the events we read in the papers every morning are new. It's that we are reacting, and arguably otherwise rational actors are acting irrationally, and that can create opportunities.
I want to ask you a quick question before we run out of time, which is this. Back in June after the flash crash, you said you were feeling bearish heading into the end of the year. Well, high yield spreads have come down. Stocks are up 10% since then. How do you think we'll end out the year?
You know, we come every morning into the office somewhat agnostic, but that has been my longer-term view. My gut feel is that we're up, and part of it is it's December. The street is basically paid to be long. There is this enormity of cash. People want to believe. There is the notion of confirmation bias. You want to look for reasons that markets will be up. Markets will be up.
Peter, it's great to have you here on the Inside Track. We hope to have you back soon. That is Peter Lupoff, the founder and CEO of Tiburon Capital.